Okay, so we now move on to the next topic of how we react to fraud and error. And, and we've come across fraud before, um, and we have some reporting standards on how we deal with errors in general. In terms of errors, if they are material, we need to retrospectively recognize these issues. So I guess we start off just understanding the meaning of what a misstatement is. So misstatements very much to do with omissions and if you like, obstructions of events within the financial statements or disclosures. Key point really is that um, we have an event here that will now mislead the user, and they will not be able to make the right, if you like, economic decisions based on this misstatement. So really talking, and it really could range again from everything to do with just classification, just the fact that you're moving things away from cost of sales into expenses. So of course you now have a sort of an error of principle somewhat that affects the way we look at gross profit margins and net profit margins, that sort of thing. Of course, where you have misstatements within disclosures or the failure of disclosure, if you like. Um, and of course, therefore, misstatements can arise from just active, if you like, an active declassification, so to speak, or reclassification, or error, if you like. And fraud isn't, when we come to discuss fraud can just simply be to do with the manipulation of financial statements. Of course, that's active fraud for purposes of trying to improve your performance outlook. And so, really, the question of error and fraud is important because, of course, fraud is intentional. There's no question about that. People have come together, or an individual has actively sought to um, take or misappropriate from an organization, as opposed to error, where there, of course, this is what I guess an error is. You say I'm sorry, I didn't know. It's unintentional. Um, and so I highlighted earlier on that you can have very clear fraudulent financial reporting, where you have someone actively manipulating financial statements in a range of manners, in a range of options, really. But the point is here, there's the end point, the end goal here is to mislead the user of those financial statements, either to acquire more funding. But we can also clearly have theft of assets, directly theft of inventory. You could be putting on ghost workers. You could be creating false invoices. If you like, there you are. So you can have fraud in a number of areas. And I talked about earlier on that it seems almost like obvious why you could have fraudulent financial reporting, but of course, where you have certain pressures on performance measures, um, if you like, on from directors in terms of their own individual bonuses for their own self-interest, but it might just be to do with the company as well. You know, maybe the company's done well for the last 2-3 years, and we are coming up to another quarterly report, and the shock of a loss, or maybe difficult trading conditions might have led to this, or who knows, maybe you have been I don't know, misstating certain assets for a while, or you had a provision in there that you were to recognize but you didn't, and now the provision itself has actually come to fruition. The key point here is these are the sorts of things that you would imagine, right, that would lead to pressure or to fraudulent financial reporting when people start trying to get creative in order to keep the profits and returns smooth, to maintain that inflow of income or clients or credit. Of course, when you have pressure on borrowing covenants, so you have covenants either coming to an end or you're not able to meet your interests, those sorts of things kind of can lead to fraudulent financial reporting. I highlighted earlier on that really a mistake is a mistake. You have made some errors in gathering the data, and the key point is that it's unintentional. It's unintentional. Again, yes, it could just be an incorrect accounting estimate from oversight or misinterpretation of facts, but or it might be a mistake in the application of accounting principles. So that's or the presentation. So you might just have disclosed wrongly. And to be fair, this is quite easy. If it's an error and it's well, even if it's material, the question here is in your year at least you can go back and fix it. It's not an issue, really. So normally corrected by clients when they're identified. No one is really you know, again, this is not typically the issue. Um, but of course, if it's not corrected, which is a strange one, it is we would have to think about modification, if you like, and see what area of the balance statement, the financial position, or the income, or whatever it is, whatever area here is being affected. We come back to the question of responsibility. Interesting point. Who is fundamentally responsible for managing fraud? Well, of course, it is the management. Management are fundamentally responsible for managing or preventing, should I say, fraud by fundamentally ensuring that they have good internal controls. Or let's put it this way: that there is a culture, right, that seeks to prevent or desist fraudulent behavior. It's very much about culture within the organization. And of course, this culture one, of course, because culture is very much about enabling people to behave in a certain way. And then, of course, because we know humans are humans, and we have controls in place to deter, as opposed to just having controls that deter. So culture is really important. Um, and then there's a lot else in here in terms of culture, in terms of why would people commit fraud? If people were being paid regularly, or if there was a long-term culture of viewing profits, a holistic way of looking at profits, people won't feel under so much pressure to report earnings that are much higher than they really should be. So, of course, management are always all about risk management and trying to prevent that. So, again, management, their aim is to to provide a strong emphasis on fraud prevention and reduce opportunities for fraud to take place. So really, it's about having these controls in place. Here, a culture of honesty and ethical behavior. Um, Again, here, it's always about trying to ensure. It's all about culture, trying to prevent this override of controls, and implementing and operating good, adequate, and accounting internal control systems. Again, of course, here we are. It's important to make sure that people also see the deterrent, if you like, for these things. But just as you can see, as we talk about all these things, culture is really important to make sure that you have that culture of honesty, and then, of course, have controls in place, and then, of course, have a deterrent. So it isn't just about the deterrent. For as far as audit is concerned, we have our job is to ensure that the accounts are we'll be giving a reasonable assurance on the financial statements that they are true and fair. So really, from in terms of what testing we do or what we go out there, we tell our clients, listen, we will carry out our procedures to pick up on material misstatement. And of course, judgment will guide us as to what we consider to be material. And within those boundaries, we should be able to pick up on, we will carry out enough sufficient and appropriate, we'll carry out processes or procedures to pick up this evidence. And that should pick up fraud. So we are not going in there looking for fraud, but we are, of course, professionally skeptic. We're very aware of general events within the organization. And that keeps us sort of aware maybe to potential fraud. Maybe from our analytical procedures, we notice some differences or an imbalance, a lack of flow between one year to the next, or we notice if we, of course, in our controls testing, we see an abuse or an override of controls that we saw earlier on here. So this question here of potential for override of controls, it's all about this holistic approach that if we see that there are issues here, then it allows us to think about the possibility of fraud, and that we therefore reduce materiality in that area, and further investigation, further substantive testing, and then we might pick something up. Right. So So, of course, what do we do? Well, we will, of course, as usual, get those standard ideas of written representation, but that's not really the point. Management will tell you there's been nothing. But really, the point is that we want to be able to um, observe if there is any by ourselves. So, discuss the susceptibility of the client's financial statements due to fraud with the engagement team. So, it's just understanding what's going on here. It might be, of course, many industries are inherent potential fraud just by the nature of the industry. And of course, inquire of management regarding the assessment of fraud. So just to see what they themselves are doing, what they have in place, internal audit function, if there have been any actual or suspected instances of fraud. Um, yeah, and what steps that those in charge of governance. So really, the onus or the responsibility is on management. Of course, I highlight here carrying out analytical procedures. So what do we do? How do we respond to fraud? Well, if we do suspect, and we're not really talking about the engagement, the fraud engagement here, we're still talking about the general audit in itself. Um, the same would apply if we were talking about an engagement just where we're brought in because an organization feels there's a fraud. It's a completely different engagement from an audit. Here we're being asked to come in. But the point here is that you want to have the people who are actually experienced enough to actually manage this and to see whether this is inherent to the organization. So maybe you have a management override taking place throughout the organization. And what you want to have is or use is unpredictable methods to be able to sort of address these and sort of test and look for them. Because again, if someone knows that your way of finding out their mistakes, what they'll do is they'll either find a way around to ensure that you don't actually catch them out on their errors. So we'll stop here and then we'll finish. Well, not finish. We'll carry on in the next video.